Hi, this is Ron Rowland for Money Markets TV. The ETF revolution allows everyday investors to achieve the impossible. Just a few short years ago, short selling, leverage, spreads, and commodities were practical only for Wall Street insiders. Now, with ETFs, anyone can play. Yet, availability does not guarantee success. You have new opportunities, but you also have new risks. So you need to know what can go wrong and be ready for it before you place an ETF order. Lately, I've gotten many questions about inverse ETFs, which are designed to go up when the indexes they track go down. With the recent volatility in the markets, a sputtering economy, and the global debt crisis all over the headlines, now may be a great time to consider trading on the short side. But inverse ETFs carry some unique risks. First and foremost, you don't want to buy an inverse ETF or make any kind of short sale unless you're very confident that your target market is heading down soon. Timing your entry and exit is critical. This is also true for bulls, of course, but it's doubly important on the short side because markets tend to fall faster than they rise. The downturn can easily be over by the time you notice it and decide to jump aboard. But while getting in too late is a risk, so is getting out too late. Many inverse ETFs have a built-in leverage factor. The intent is to amplify your gains by 2 times or even 3 times. Sounds great, right? Go 3 times short and a 5% drop in the market turns into a 15% gain for you. Well, not exactly. In most cases, the leverage factor is reset every day. This means that over time, the value of your shares can drift down even if the market moves in your favor. For this reason, leveraged and inverse ETFs are best for quick strikes. Get in and get back out as soon as possible. Remember, timing the market is tough even for professionals. So if you make a mistake, admit it. Don't just sit there and hope for a recovery. Another risk that comes along with inverse ETFs is counterparty risk. ETF managers employ various techniques to get the correct market exposure, often including derivatives like futures, options, and swaps. With those types of instruments, there's a chance that the other side of the trade won't make good on their bet. I'll give you a more concrete example to explain this concept. Say you buy a plane ticket. You agree to give the airline a certain amount of money. The airline agrees to have a seat available for you on your selected flight. But if you don't pay for your ticket, or the plane takes you to the wrong city, that's a form of counterparty risk. Defaults on equity swaps are very rare, but there's always the possibility that it could happen. This is one factor you need to consider when deciding whether an inverse ETF is what you need. Every ETF has a prospectus with detailed information on its characteristics, fees, and risk, which you can find on the sponsor's website. Always read it before you invest a dime. If you don't understand something, get clarification from a reliable source. I'm Ron Rowland for Money and Markets TV. Thank you for watching.